Entrepreneurs, professional accountants, and auditors. In the next 60 seconds, I'll show you how we can calculate a cost of capital quickly using our brand new product, WACCFINDER. The first thing we do is select pricing if you've not been here for the first time. And if you're an entrepreneur trying to assess what is the minimum requirement a investor wants before they would invest in your product, choose the entrepreneur plan. If you are a professional and you would like to calculate the cost of capital for statutory financial reporting, choose the professional plan. And because I've already registered, I will just log in immediately. And in the next 60 seconds, we will calculate your WACC. There are only 8 fields to go through, and most of the fields require you just to select predefined values in the drop-down box. Let's go. Let's take December 2023. And duration of cash flows, right? So if you're doing a DCF, discounted cash flow, and you're doing a going concern, choose 5 years and above. Country of operations, let's try Singapore. Now I want you to pay close attention to this to see how this impacts the other values down the line. You notice that because we've selected Singapore, it defaults to Sing dollars, but we always give you the ability to override. So you might be a Singaporean company, but if you invoice in US dollar, we allow you to override, right? So we've got 93 countries in our database. Select industry. Let's say you're from specialty chemical. And small cap premium for unlisted companies as a proxy, just look at your balance sheet net asset value. If it's below 451 million, pick the smallest one. That's it. We're done with cost of equity, 11%. Cost of debt, look for that on the balance sheet. Look for long-term cost of debt. Let's say you've got a loan more than 5 years and the cost of debt 6%. That's what you put in here. Tax rate, again, defaulted to 17% because it's Singapore. But of course, we give you the ability to do a manual override. For example, if you've got some long-term tax incentives, that gives you an effective tax rate that's lower than the marginal tax rate. And the last question, the target's debt as a percentage of debt to equity. As a proxy, look at the long-term debt on your balance sheet divided by the long-term debt plus equity, right? The formula is here so that you know which line items to look at. Let's say it's 50%. And there you go, right? So for the first time ever, auditors, all professional accountants now have valuation expertise at their fingertips. Previously, if you were trying to do an asset impairment testing exercise or fair value exercise, and the client gives you a very low number, let's say 3%, the auditor or the professional accountant didn't have a right or reply, right? They would either have to pay thousands or tens of thousands of dollars to a business valuer and wait for weeks before the answer comes in. For the first time ever, I've shown you how you can get the answer in 60 seconds. Not only can you get the answer, you can save it, right? And if you save it, you can then view it so that you can remember that, put in your company name, of course, right? We didn't type that in. It will remember your currency, your country, your industry, and your valuation date and who created it. And if you wanted to order a report because you wanted a Vallaris CVA accredited value to sign off, you can do it here. We'll show you in the PDF report all citations and with sources. And you can email and send this to your client and start the conversation. Thanks for watching.